What's up? It's your boy Peasant. We're gonna do a little bit of an idea that I have in regards to volatility. Volatility is measured many different ways, but one way to measure volatility is through the options price. So the Black-Scholes model, I'm not entirely, I don't know what goes into that, but I do know that a main component of the Black-Scholes model is the option price, and the people who are willing to pay. The people make the market, okay? And if the person is willing to spend more money on the option than the day before, then it's looking like, and the price is the same, it's looking like, well, it might have more of a chance to make more money. It might be worth more because the volatility is high enough to be able to be, okay, well, I'm willing to pay that because it could go higher. It could go way higher. The capacity is not $2 anymore. The capacity is maybe 3.5. It's like, well, I'm willing to pay more money for that option to be able to ride that thing if I can. So that's the idea. So I'm thinking about doing some type of scanner to find huge volatility, and I think that would be implied volatility. I'm not exactly sure, but I would use option prices as my volatility indicator, and this is a larger time frame. This is a daily types of trades. Now, here's the deal. This is what my strategy would be, because I've developed all of my thinking in terms of trading and using futures. So it's purely directional. I'm not using options, and I won't use options. But my idea here is that if the market is, let's say, not volatile, you might see the daily chart kind of like this. I don't know if you can see that, but it's really not that much. In comparison, let's say right here is a volatile chart. You can see that in the same time frame, it's gone. It's moved just so much more. In the same time frame, this is volatile, this is not volatile. And I'm saying that the implied volatility will give me these guys. It'll give me these guys. Okay? And the system that I would use is this. Let me grab a different color here. I'm taking this. So, the idea would be this. So, if, let's say, we put a small risk box. Let's say this is the risk box, right? This is how much we're willing to risk. Let's say we buy it on the way up, right? Oh, you can't see anything. Let's say that's our risk box, right? This is our little risk box. We pile on however many contracts it is, share price, whatever. It's worth $200 to us. If that's our risk box and it moves up, we can move our stop to break even. Now we're risk-free riding a position, and that's fine. That would be like my idea. Now, this non-volatile, it's not worth it because it just doesn't move that much. However, if you say that same risk box, yes, the risk box tiny. Let's say we get in right here. Right here. So it stops us out. I don't want to pick something. It's the same risk box. It's the same size. But because this market is willing to move so much, the risk-reward capacity is so much greater. And we pay the same amount of price. We pay the same price. We don't have to pay the inflated option value because we're not paying for options. We're paying for the share. We're paying for the stock. So our price is not inflated at all. It's the same the same thing, but we are still taking advantage of the volatility, and we want to be paid on the volatility. So this one goes up, yeah, I'll move my stop to break even. I'll move my stop to break even when it goes up 1R or something, and I get stopped out, fine. But maybe on the next rip or breaks this high, whatever, we have the same risk box and we can try again or whatever, drag your stop to break even. Now you're riding a bigger trade. You're riding one that goes way further than it's ever possible with a non-volatile stock. So I think that's what my idea is. So first and foremost, it's a little, it sounds good, but it's a little confusing because what are we using as a risk box? And I would just use some measure of percentage of the price. No, I wouldn't use ATR because I don't want when it's a volatile stock, I don't want a big risk box. That's the same thing as if trading a non-volatile stock with a small risk box. I want a small risk box because the chances of price moving, here, I'll show you. The chances of price moving and taking it with us is greater. So let's say this is not volatile. All right. Whether the trends or not, it's just not volatile. Okay. The chances of us randomly taking a stab at it and moving in one direction is okay. It's decent. But when the price is really moving, just absolutely crazy, the random time we get in, we have a greater chance of it never coming back to this spot where we can move our stop to break even and it won't actually come back, because when it's volatile, when it's moving 10% or 8% in a day, we got in 8% ago because I didn't say that this market will move up. It just happens to do that because it's so volatile. The worst case scenario is purchasing in a very volatile asset and then it goes in against us. Let's say we're short, we go short and it goes against us and we ride a short position the whole time. Maybe we double down up here, double down, and we just lose our account. And the idea is we would do the same thing for us, because the chances of price riding us in a direction, doesn't matter up or down, a direction is greater in a volatile asset. So we want volatility. We would filter these guys out and we wouldn't trade them, and we would trade this, and we would have some type of standardized system to have small risk boxes and some type of way to get in, and their opportunity is there because if you look at the chart and it's so up and down, or just up or just down, doesn't matter. It's so directional. It's just so directional. Whether it's up and down, this is directional. It's up and down. It's moving. Price is just moving counties. And the idea is if we get in, we have a better chance of it just pushing away from us. See you later. Bye. You're never going to be here again. You're not going to be here for a long, long time. And or ever, sometimes it just runs for a long time. So our exit strategy would be, I'm not sure, perhaps trail stop when it gets to a certain point. I would want to give it space. The whole point is to give it space. So yeah, that's my idea. That's what I was thinking. But there's a lot of ideas out there. There's a lot to test. But yeah, I mean, there's plenty of things we can do. I was thinking that has potential. I'd have to figure out a lot of things, obviously, and we'd have to back test it. And we'd have to figure out our entry point. And I have a way of getting in. I have a way of getting in. But yeah, we want the risk boxes tight. Tight risk boxes are great, in my opinion. All right. It's just one idea, mate. There's plenty of ideas out there, mate. It's just one of them. All right, peace.